What's next for markets?
Hello, I'm Stephen Gregory. I head the quantitative research effort, Piper Sandler. I'm filling in this week for Michael Kantorowicz. I'm joined here today by Emily Needell, who is the Deputy Chief Investment Strategist at Piper Sandler.
Hello, Emily. How are you doing today?
Stephen, hello. I'm doing great.
So, Emily, we are just a little over a week left in June, which will put us just a little over a week left in the first half of this year.
I feel like we say this every year, but this year in particular just feels like there's been so much that happened. It's hard to believe it all happened in just 2 quarters, and also it went by so quickly. So definitely hard to believe that we are coming up to that halfway point already.
Yes, and something we do that I don't know if everyone who's listening is aware of for our institutional clients is every quarter we put together a what happened in markets. And it's one of my favorite pieces because we all get so caught up into what's happening today and what happened over the last week, or stock had 3 up days. Like we all get so tied into this and we often don't pull back and see the forest through the trees. And I'm always so surprised. Now, it's something we've been doing for a few years now, but I feel like I always learn so much by pulling back and looking at what has happened. It just gives you so much insight and helps explain when you think about where we're going. There are 2 things that are just tied so closely together. So I know you started working on our quarter review, but let's talk about the first half because I think the first and second quarter were so closely tied together. What were some of the big events that stood out to you?
Sure. Certainly, as we all know, the policy headlines have been really driving markets and driving everybody's sentiment this year. I mean, it's hard to believe it wasn't even half a year ago. We came into 2025 in a backdrop where everyone was talking about deregulation, pro-growth policies, the return of small caps. There was so much optimism. And then if you recall, very early in 2025, we started to lose some of that optimism and momentum. We started to be more concerned about tariffs and what might come. And then you had Liberation Day, April 2nd, which just blew up what everyone had been expecting, with the tariff numbers being just so far off the charts and so far off what people were expecting. And that really crushed markets. And so basically what you had was the first quarter was mostly a decline, a slow bleed for markets that really culminated with that April 2nd tariff announcement. And then since then, obviously, we are not near the lows that we were down on April 2nd. We've recovered quite a bit. April 9th, we paused the tariffs for most regions were paused. And so since then, we've been on an uptrend. And so it really was a V-shaped move that we've seen this year, with the first quarter being a downturn and the second quarter being more of the upswing. And in many ways, we are now back to where we started the year, particularly when you're looking at large caps. The S&P 500 is very close to where we were at the start of the year, and about 100 points or so from all-time highs that we reached in February. So it's been very much a year of headlines, a year of uncertainty, and a year of narrative volatility, with the tone changing so quickly from day to day.
Yeah, we came into the year with expectations. I remember people throwing around lag 7 and time for small caps and value. And then here we are sitting today where that at the very beginning was looking right. And now the largest or best performing size and style box is large cap growth. We're kind of right back.
We are right back to where we were. That is so true. I was just looking at a matrix that we have. It's one of my favorite charts that we look at that shows performance of the size and style boxes for the S&P indices. And what you'll see is, even though the S&P 500, so large caps, are basically back to where we were on the year, up a little bit, large cap growth is up a little bit more than that. So you've got at least 2 of the 9 size and style boxes that have made gains so far this year. Everything else is still down. And when you look across small caps, they're down the most, and small value, which tends to be the most cyclically sensitive area of the economy, is still down about 10% year to date. So far from a full recovery there. And so I think it is really interesting that even though it looks on the surface like we've really recovered most of what we lost in terms of the market sell-off, and that is true for larger caps and the S&P 500 in particular, you haven't seen that same V-shaped recovery in every area. Certainly, we've seen a move higher off the bottom for all areas of the market pretty much, but we haven't seen the rebound have the same magnitude as it did on the downturn. And there are still risks out there, of course. A lot of the issues that took down the market initially have not been fully resolved yet, and it could be quite some time before they are fully resolved. And so we are still in many cases in a wait and see kind of backdrop, although it does seem as though investors are more willing to brush off concerning headlines now than they were earlier this year when it was sort of the first time that we were hearing about these kinds of tariff concerns and whatnot.
It's very true. All year, and Michael and I were talking about this in last week's episode, there's been so much uncertainty and so many things to worry about, but not much has often materialized from it. And market has looked past. Tariffs and earnings, perfect example. You saw earnings expectations take a hit with the initial announcement, but it really quickly recovered. It was very minor, almost muted response to estimates. And now earnings for the S&P 500 are at an all-time high, and small and mid-cap, different story, but they're still on basically similar trends to they were pre-Liberation Day levels. And while we are not at those reciprocal tariff levels, there are still more tariffs in the system. As Andy LaPerriere, the policy analyst, always loves to point out, even without that, we are still at generational highs, 100-year highs in tariffs.
Yeah, and that's true. And certainly what he says is that's not likely to go away anytime soon. Trump really wants these tariffs. He believes in them. And so he's going to do whatever he can to keep them as high for as long as possible. And we are still going to be in a backdrop of uncertainty, certainly at least for the next several months and quarters. And I like to think about what we can do as investors to sort of best position for the road ahead. And in this last half of the year, we did have those big swings where markets sold off and then rebounded. And ultimately, what best served investors throughout that process was to be more balanced and more of a quality focus as opposed to trying to swing for the fences in either direction. Of course, defense outperformed on the way down and risk outperformed on the way up. But ultimately, at the end of the day, if you had just been in a more balanced, higher quality tilt, you would have managed to have outperformed with much less volatility. And so that is still the recommendation that we have as we look out for the next quarters, because there's still quite a few uncertainties out there, one of which being the tariffs and also the Fed. The Fed came out this week, and there's still a lot of uncertainty about whether there's going to be any rate cuts at all this year. There's a lot of back and forth in terms of what to expect there. And that's another overhang that is a big question that investors are focused on that we just don't have an answer to yet. And it's really going to be data dependent, as they like to say, as we go. And there's still a lot of uncertainty around what's going to happen there.
Speaking of data dependent, we talked a lot about the overall market. What happened with economic data this year? Want to give us a little recap?
Sure. So economic data has been such an unusual backdrop that we've been in when it comes to economic data over the last couple of years. Throughout my whole career with you, and even before, if you can imagine, Stephen, that I had a career even before you.
There was no life before we started working together.
Well, that is true. But there has been, for the most part, business cycles ebb and flow. There's usually a clear acceleration or deceleration. It's rare that we have been stuck in a holding pattern like we have been for the last several years. And that's really been post-COVID. We've been in this backdrop where post-COVID inflation shot higher, rates moved much higher after being at zero interest rate policies for a long time. And so now we've got rates that are uncomfortably high, and they've remained high in levels that are restrictive. And so we haven't really seen much movement when it comes to the business cycle. You haven't seen big improvements in the cycle, nor have you seen big declines in the cycle. And so we've been range bound and volatile in terms of economic data for several years now. And so even looking at this year, we've continued on that path. So a couple examples of what I'm talking about here. One, housing activity. And we've just seen housing data continue to bounce along the bottom in terms of there's not a whole lot of movement in terms of housing activity. And again, that's largely a function of the fact that rates are high and uncomfortably high. So people are not incentivized to move. Secondly, if you look at PMI data, which have historically been some of our favorite ways to measure economic growth, if you look at an average of the ISM manufacturing and the ISM services indices, so you're looking basically the full economy, that series, that average has really just been bouncing around the 50 threshold, which means that one, it's not really accelerating or decelerating. And two, the 50 threshold is what separates expansion and contraction. So if you are bouncing around 50, it means you're basically going nowhere. And so this has just been going on for years, and it's something that you just really have not seen historically. So to say that the economy has been somewhat stagnant is, I think, a fair way to put it. Certainly, you have seen growth in some areas. And as you mentioned, larger caps, for example, have seen really strong earnings growth, but smaller caps have seen their earnings expectations continue to decline. So it's been bifurcated in that sense. And we've, again, been just continued to be in this world where there's no clear direction.
That's so true. That chart you mentioned of the ISMs, as you know, is one of my favorites. And the services one, I think, only goes back to 97. But the manufacturing one goes back to 1948. And so even if you just look at the manufacturing and you look at a chart that's 70 plus years long, it goes up, it goes down in these big, beautiful patterns. And over the last couple of years, it's a tighter around 50 if you look at the average of them both. But it's been a flat line. That has never happened before. There's not many times you can look at a series that goes back that far and find something that's never happened before.
It's been so frustrating for investors who are used to seeing major shifts in leadership patterns in the market. And typically you would see periods where, the cycle's moving higher and you want to add risk to the portfolio, or the cycle's slowing sharply and you want to add more defense. And we've been in this backdrop where it's really been kind of stuck. And that's been very unprecedented, like you said. And I think people are frustrated thinking, how much longer can this continue? And it has managed to last, I think, quite a bit longer than pretty much all investors had expected. And that's something that we don't see any clear catalyst for that ending anytime soon, barring some type of major crisis or unforeseen event.
Yes, absolutely. And that's been basically the story of the year, headline wise, has been Trump and tariffs. For the market, it was about the V shape. And for economic data, it was continued range bound. And it's not just this PMI series. It's, as you said, housing, rates, employment data. Everything has basically gone sideways, which then puts you in this situation. A lot of people listening are like, well, no, every month you hear about this going up and that going down. But you're just stuck in this channel. And the average of all that is essentially going nowhere, which, as we all know, the fallacy of averages, if you have a data set and you calculate the average, there usually aren't data points that are actually the average. So you have the bifurcation between large and small, but it's definitely a unique backdrop where we just can't seem to get out of that trend.
Absolutely. I know. I would like to just mention, since we haven't really talked about it yet, sectors and what sectors have done so far this year, because I think it's pretty interesting when you look at sector performance since the beginning of the year. So you've got the S&P 500 that's up just a couple percent at this point. And then you've got most sectors that have gained quite a bit. There's only two sectors that are down year to date, discretionary and healthcare. And we know that Tesla plays a big role in terms of that discretionary underperformance. But at the very top of the leaderboard, you've got industrials, comm services, utilities, financials, staples. And so it's just kind of an interesting kind of amalgamation of sectors that you've got some risk sectors, some growth sectors, some defensive sectors, all at the top. Again, it all boils down to this is not as clear cut of a cycle as what we are normally used to seeing over the last decades, where there's a clear acceleration or deceleration in the economy. This is a bit more nuanced, given that we have been sort of stuck in this channel where we've been bouncing around between things getting a little better and then getting a little worse. And I think you can see that in the sector level. And I would add on top of that, we do like to point out, everybody looks at sectors. We like to know what's going on within sectors because it's interesting and it's kind of a clean way to break apart the world. But we've done a lot of work as a team talking about the issues with using sectors and why we tend to look at factors over sectors. And so maybe it's worth just mentioning that here. There's really three main issues with using sectors, which is reasons that we prefer factors to sectors. One being the concentration bias. You can have a few stocks can explain the entire sector, Tesla being sort of an example of that this year. Point number two is that sectors can have a diverse range of fundamental attributes. So not every stock in a given sector is similar. And then three, sectors change over time. The constituents change over time, the fundamental traits. The tech sector today is not like what it was, the tech sector in 2000. And so while we always kind of keep our keep an eye on what is going on with sectors, we tend to be more factor focused. And if we look at factors this year and where we stand now after that V-shaped recovery we saw in markets, interesting to know that the worst factor of the year so far between the S&P 500 is beta, followed by book yield. And we've also got right behind those are some leverage factors. So even though we've seen a recovery in markets, you really have seen that people have not wanted to press into those lower quality cyclical trades. And that's, again, we did see a bounce in those groups off the bottom, but not nearly as much of a bounce as what we saw on the downside. And that's why these are still the worst lags of the year. And so I just think it's interesting to note that even though on the surface it may seem like the S&P 500 has fully recovered from where we were, the factors show that people are not quite as optimistic and not reaching as much for risk as what you might think if you just looked at the headline index itself.
That totally describes the kind of overall sidewaysness of growth for economic data, of broad growth, but bifurcation underneath. Very interesting. So that was a great review. Thank you very much of where we've been. What are you thinking going forward? More of the same?
That's always a $1 million question, Stephen. Yes. I mean, ultimately, there's no catalyst that we see right now that's going to change the dynamic dramatically. I think some of the risks that we see going forward, oil being a big risk here. We saw a big move higher. Oil prices had gotten as low as being in the 50s, mid 50s. Now you're back up to the mid 70s. That is, lower oil prices was something that was helping to offset price increases due to tariffs. And if we've now got oil prices up a lot too, that's just going to exacerbate the increases in prices from the tariffs. So that could potentially throw a bit of a wrench into the ability to kind of just muddle along in terms of economic growth. So that's something to keep an eye on. As far as positioning and where you want to be, again, as long as we've got rates that are higher for longer, we're going to continue to want to be in higher quality stocks, larger stocks that have easier, cheaper access to credit, stocks with stronger fundamentals. Again, sort of more of the same, but obviously we're going to be continuing to ebb and flow just like we have been, with some weeks feeling better, some weeks feeling worse, but ultimately unlikely to be making big progress in either direction in terms of the economy accelerating or decelerating.
So once again, no rest in the second half of the year for us market pundits.
Stephen, there's never any rest for us market pundits. We need to, the faster we accept that, the better it'll be, I think.
Very true.
And I feel like every quarter, I mean, think about COVID and then everything after COVID, every quarter feels like there's something completely unpredictable that happened and unexpected. And that's why this job is so fun, because it keeps us on our toes.
Absolutely. Thank you so much, Emily. This was great.
Thank you, Stephen.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.